Good day, everybody. This is Jim Kinney, OptionProfessor.com weekly market update for November 2, and this is 2018. By way of introduction, I am a graduate of Boston College, and I've been in the investment business here for over 30 years. And I am very familiar with all the different markets from stocks, bonds, interest rates, of course, and then, of course, the gold and the dollar. These are the things we're going to cover here today. And again, as I say each and every week, past performance is not necessarily indicative of future results. And when you're doing short-term trading on stocks or options, there is a risk of loss. And so you should consult your financial consultant, your clearing firm, the people you're buying and selling through, and your good common sense to find what, if any, strategies may be appropriate for your circumstance. Okay. All right, let's get into it. We had a meeting on Monday, and on Monday, when the markets were down, I made a point to say that I would be looking for a big rally this week, possibly, because of some of the things that would be coming out, like the earnings and also the unemployment report today and other things as well. And we did get quite a big rally. Again, the VIX was elevated and the RSI was very low. And so the setup was there for quite a good rally, which is exactly what we've seen. Now today, yesterday after the close, Apple came out with their earnings, and again, they did disappoint a little bit with the sales of the iPhone. In fact, they're talking about suspending announcing sales of the iPhone, the totals on their subsequent reports. That got people a little bit concerned because it's such a big part of their business, and they're trying to obviously focus on other parts of their business. Also, the situation on the prices of the iPhone were higher. That, in my view, is another inflationary indicator that prices on items that people buy may be going higher. The unemployment report today is another big one, and that came out at 250,000 new jobs, with the unemployment report staying steady at 3.7. The big news in the report, as far as I'm concerned, is the wage inflation, which was up 3.1%. That's the highest level beat since 2009. So, you're talking about, some pretty good inflation on the wages, and the unemployment report 3.7 is still the lowest level since 1969. That should translate into the consumer having a pretty good amount of money and interest in spending money, providing they don't look at their statements on stocks and show that their stocks lost value in October by a substantial amount. The wealth effect thing is something to keep in mind. With regards to the technical picture on the stock market, as I've been saying, the 200-day moving average is at 2765 on the S&P. Let's take a look at the S&P graph here so you can see that, and we'll go over the stock indexes right now. Today's high point is 2756. As I told you, that 200-day average comes in at 2765. So obviously we went up towards that 200-day average and have rolled over to the downside. We're currently around 2732 on the screen right there. Again, the gap you see right under 2700 is a fairly substantial gap, and it could be a situation where we may go back and fill that. If on Monday we do not take out today's high of 2756, then we could roll over a little bit next week. I'd be careful of that. Of course, the midterms are Tuesday. That's going to have a big effect possibly on volatility as well. A big unknown card there. So, going into Tuesday, there could be some people who really don't want to be too exposed to the market one way or the other. And so it could be a little bit either quiet or fading because Tuesday is such a wild card unknown. With regards to the VIX, let me take a look at the VIX here. So again, important levels on the S&P right now would be that 2765. And the other important level is on the VIX. And the VIX has been in the 20s, which is an elevated stance. When you're in the 20s on the VIX, there's still a chance of a big sharp drop because the VIX above 20 is, in my view, elevated, and 15 is an equilibrium, and 10 is a low. So right now we're on the ledge here at around 1990. We did dip to 18. Last time we had a rally, the VIX dipped to around 17 and then went back up to 28. So you have to be a little careful here that next week we could possibly roll over, particularly if we cannot take out that 200-day moving average around 2765. And of course, if the Tuesday election is not friendly to the stock market. Now, with regards to the VIX right now, 1990, and again, if we hold this 18 area and we start getting back above 22, 23, and then something occurs on Tuesday that might not be market friendly, we could very well get another retest of the lows, if not take out the lows. So there's a lot of people pounding the drum on a lot of the TV stations. You should run back in here. There's going to be a massive rally at the end of the year. That is a possibility, but it'll only become a real possibility to me if we close above the 200-day moving average of 2765 and we can get the VIX under 15. Then I think you'd be in a very good position to make a statement that an overall uptrend may be back in case. Otherwise, you're looking at rebound rallies from oversold positions. And again, as the market was overbought in September, when things like Amazon hit 2050 and its 200-day moving average was down at 1550, then that's 500 points above its 200-day moving average. And here's Amazon. At that point, I was suggesting people investigate hedging. Now, we're up above 2,000, and I'm sure you all have some stocks out there similar to this. When you're up at a high point here, 2,250, and I tell you that the 200-day moving average is down at 1,550, what you want to look into there is buying a put against your stock using some of the gain. Look at the gain you've had, 1,400 up to 2,000. You got plenty of money in there. Why not take a little bit of money and buy a put? And then when it drops all the way down like it did, that put is a protection against your equity. Now down here, you could cover that put, and now you're long again without insurance. Or roll the put down, which means you bought a put up here and now it's down here. So you take a profit on that put and then you buy a lower one in the 1,400 area. And that means you're rolling down the put, taking a profit on this one, which would be very, very high priced now, and buying a 1,400, which would be substantially less than a 2,000 or a 1,900 put. Right now, again, this market was oversold again this way. It got down way down there. And so now it's bounced back up. But again, a lot of technical damage here. And so if I was a guessing man, I would think that maybe your best case scenario is a sideways trading range, unless the four things that are standing in front of us all break the right way. And what are the four things standing in front of you? Very simply, you've got Tuesday's election standing right in front of you. You've got the seasonality where November has been the second best month of the year historically, where you've got 47 years, November has been up, and it is the beginning of seasonally the best 6 months in the stock market. You've also got a meeting with China at the end of the month, and the people are talking about an infrastructure bill coming through, very stimulative. And then, of course, you're talking about buybacks. There was a dark out period where the companies could not buy back their own stock because at the end of the quarter, 2 weeks before, you can't buy your stock back in many cases, and then until your earnings come out. So those will be lifted in November because we're past the end of the third quarter and the earnings will be out of the bag. So that'll open the door for people to buy back their own stock if they'd like to. And these companies are sitting on lots of cash. That's not off the table. So are there bullish things ahead of us? Absolutely. Could they turn into a very strong rally at the end of the year? Absolutely. But without the technicals turning properly, I would be a little hesitant to put on the party hat just yet. But clearly, we'll be looking to see if that S&P low point of 2,600 can hold. And that is right now the line in the sand, 2,600 on the S&P, which was the low this week. Okay. All right, so there you are in your stock indexes. Again, you're getting a rally, and strategies, if the market lows are in, would include put selling and credit put spreads. If you don't understand these strategies, or you'd like me to talk to me more about the use and the risk of the tactic, it's real simple. You go to OptionProfessor.com. And then you obviously get into the link for this meeting, but also you can shoot me an email. Option, OPTION, Professor, PROFESSOR, @gmail.com. take advantage of that. I'd be more than happy to answer your questions and give you a little bit more clarity on some things that you might be unclear about. And I think it'd be very wise to take advantage of that. Okay, so on the stock market again, today you're looking at a market that's rolled over a little bit from the opening. I mean, we were up 300 or 400 points before the market opened, and as you can see, the Dow Jones. Let's just see where it is right now. See if it's come back at all. And no, it's rolled over. So it was up 400 points before the opening, and now we're down 46. That's a pretty good swing, and that's why that VIX is getting dangerously above 20 again, and that means it could be the bloom came off the rose. Let's look at the transports. They were very, very down. They led us to the downside along with the Russell, the small caps. Let's take a look at that real quick as well. All right, right now you see that stem up there at 10,500. I thought that was a very big area, 10,005, because it had stopped there before. It busted under 10,000. Now it's come back to 10,5. Right now it's at about 10,4. So next week, again, this week's high, 10,513. If we can't take out that number, and if we can't take out the highs of the S&P by Friday of next week, then the market could be vulnerable for a downside move again and a retesting. So be careful of that. But again, there is a lot of things on the horizon that could be quite bullish. So you don't want to get negative to a negative after this kind of a drop, which is what I said on Monday at the meeting that I was at. I said, do not get very bearish at 2,600 on the S&P, not with the RSI down here and not where the VIX elevated, where you've got some things happening this week that could be quite positive. And again, in hindsight, of course, that was very, very accurate. Right now, though, we've had the bounce back up. It's been a violent thing back up. Again, before the October statements go out at the end of the quarter, you sometimes get window dressing. I don't think it's a coincidence that the last 2 days of the month was a big bounce. So those statements that go out to the public are a little less gory than they would have been if they would have showed you the lows that occurred in October. So I personally, my opinion is, don't think that's coincidental. But now that the statements have been out and we got a new month, again, you need to have new gasoline in the tank to get the thing to run further. Let me just take a look at the Russell and see how that's hanging in there or not. Again, the Russell and transport led us up. They also gave us an indicator that was dropping. Broke under 1,700. You can see it was sayonara. Had a bounce back up to 1,600, then back down. Now we've come back up here to the rally. Today's high is 1,557. I'd mark that and see if next week we can take that number. It's fading a little bit today, but it is hanging in there a little bit. But again, if you look at it right now, the best you can say is we've had a bounce back. Let me show you where the 200-day average is on the Russell, and that would be another indicator that the lows might be in if we can surpass it and sustain it. Okay, it's 1617. So you see, we got oversold. We went into the 1400s here, right? And so we went into the 1400s, and the 200-day moving average is in the 1600s. That's oversold. That's why you're bouncing back up. But you can see 1600 may be trouble again. 1617. So we're only about 50 points or so away from that. So again, be a little careful that the bounce back rally is just that. A bounce back rally. Don't forget one other thing. The longer that these markets remain under their moving averages, the more likely that they'll invert. Right now, you've got the 50-day on the Russell at 1644, and you've got the 200-day at 1617. They're not inverted. They're actually still inverted positively. But the longer you're under 1617 and 1644, those numbers, because they're moving averages, will turn down. And if they cross, they call that the golden cross, the 50-day under the 200-day. That might be not so positive looking into next year. So it's going to be very exciting. Keep your seatbelts on. But if we can get above these 200-day averages, you can get the VIX under 15, then I think you're in there. And I think then the concept of we're resuming the bull market makes a lot more sense. Right now, I think people are catching a bit of a falling knife here, unless those four things I mentioned all turn positive. Okay. All right. Let's turn to the interest rate market, because that's another market that people are interested in. And people that are owning bonds, they've been losing money all year long. Why is that? Because interest rates are rising. And why are they rising? Because, again, the Fed is in a normalization process. And if they're normalizing interest rates, they may be normalizing stock prices as well. And that's why if stock prices are going to go to their average, which is about 7% a year, last year and this year, if you went and averaged them out to try to make it an average of 7% each year, that would take the S&P to about 2850 by year's end. That's probably not off the table, and that might be a realistic view on what the end of the year looks like. With regards to the interest rate rising, you can see ever since December of last year, they've been hiking. And you can see that we've seen a 50% increase in the yield on the 10-year Treasury, which is at 318 right now, almost 319. Okay. Now, again, you've got wage inflation now at 3.1%. Fed funds is like 2%. It can't stay at 2% with wages going up at 3.1. And the other thing you've got is a lot of people are saying that the tariffs are going to translate into higher prices because these companies are going to have to pay more. They're going to have to send that cost over the consumer. If the consumer's got a job at 3.7% unemployment and their wages are growing up, they can probably absorb it, which also means we can absorb higher interest rates. So I've been suggesting to people that are in fixed income to keep their maturity short, 6 months, 1 year, 2 years, that kind of thing. The 2-year Treasury is almost at 3%. The 10-year Treasury is only at 3.2. I mean, that's 5 times the duration for hardly any difference in yield. Okay, so my suggestion has been to keep the maturities nearby because you're getting well paid on the front end. And then when and if we see some type of a topping in yields, or we see some of the numbers in the economy turn over and there's a realistic expectation that a recession may be happening, then you extend your maturities and go to your 10 or 20 years at that time. Again, that's how I see it. That's my view. Again, you lose a lot less money when interest rates go up if you're in the front end using your common sense. Your duration is very nearby, so your money's going to be coming due. When your money comes due, you'll get your principal back if it's a treasury, and you'll be reinvesting at the higher yield if rates have gone higher. Okay. The risk is rates really tank from here, and then obviously you're chasing the bond market the other way. There's no evidence of that right now, so I'm not going to be thinking like that. The Fed is planning on hiking in December. I think they're going to do it. In fact, my view, and again, all today is my views, is that if the S&P can stay above 2,400, the Fed is going to remain on their program of gradual increasing of the rates. That's why they said when the market dropped really hard and Trump was yelling that they were crazy, they said, listen, we're not going to let a short-term drop in the stock market change our view, because they know that markets go up, markets go down. And stocks are more of a valuation bet than they are on anything else. You're betting on future earnings. Why else would Amazon be dropping like this after a very good report? Because their valuation is too high. And when you have a very high valuation, you meaning your PE ratio is way above 100, you've got to really knock it out of the ballpark to keep that valuation. And they guided a little bit lower for the fourth quarter. As a matter of fact, Amazon, I believe Apple, and some other company are predicting or forecasting that the fourth quarter sales here may not be as robust. So they're not exactly predicting a robust Christmas season. They could be wrong, but that's what they're saying. If it is a huge season, then obviously the stocks may benefit from that, and these rates may go higher than they are right now, particularly with the Fed possibly hiking in December, which I think is a very high probability. So again, if you're in the fixed income market and you've been, not very happy with your results, watching your principal drop, what I've suggested is to look at the front end and park your money in the front end while this interest rate cycle runs its course. Okay, what about the U.S. dollar? Okay, on the U.S. dollar, again, I had been thinking that this 97 area is going to be the area where it peaks. It's possible it could go a little bit higher than here, but I do think if you looked out a year or two or so, the deficits and possibly a slowing economy cannot be too positive for the dollar, I don't think. And so some people think there's a secular bear market coming in the dollar, and I don't think that's a crazy thing to think. But right now, the dollar has a very good support system in a strong economy and a very good strong support system in higher interest rates, particularly as the differential between European interest rates and Asian interest rates are compared to ours. We obviously are the clear leader, and so that's been helping the dollar quite a bit. What's not going to help the dollar is an expanding deficit of $1 trillion. And if they do infrastructure, even more so. And when these tax cuts come home and they see tax revenues really fall off the cliff, particularly if we ever did go into a recession, then it could get very messy for the dollar. And that's one of the reasons that the gold stocks have been doing well, which is I brought you to your attention here for the last bit of time. I would be investigating and have been suggesting people investigate how to start possibly accumulating something here in the gold stocks. Let's go look at the last 10 years on the GDX. Because if you're raising interest rates because inflation is going to be a problem, and if the dollar is going to be having some problems, then maybe you're looking at some of the lower points here for the gold miners. Certainly, you're not sniffing around at the highs. The highs were up here 10 years ago at 2011, up near 70. You're down here. The low's been about, I think, around, I'll call it 15, 17 area, and you're at 19. So it's not tremendously far from the lows. And again, this could be a longer term accumulation, and this could be what they call a diversification in a balanced portfolio, protecting against a dollar that could drop sharply or inflation that could pick up. Either way, this is not a terrible place to start sniffing around from the standpoint of valuation, because obviously it's been a very discounted price, and the lows came in around 2016. So we've been 2 years since we've made a new low. That might be telling us that that selling obviously may be over. So I would direct people to keep an eye on that. You know, two markets I've been keeping an eye on also, if there's going to be a situation where the Chinese and the US are going to get along better, two stocks that I've been watching very closely is Alibaba. Now, Alibaba's one of their head guys was on the TV here today, and he was saying that the Chinese consumer is in very good shape. And basically, he was saying that their debt is 49% versus the U.S. consumer's debt of 77%. So they are far less leveraged than the U.S. consumer. They also have a very good savings rate over there, and basically their wages are increasing. So he believed that the Chinese consumer is in very good condition, particularly in comparison to the U.S. consumer. Also, the Baba announced some of their earnings and information, and they had a 90% increase in their revenue in their cloud business. And that seems to be the future here. And a lot of companies that have good revenue sources in the cloud seem to be doing quite well. They also have so as you can see, the low has been 130, and I think that was made somewhat recently. You can see it's already gone from 130, which I think it happened this week. 130, it's already up to 150. So keep an eye on this. Keep an eye on these 130 levels. If it breaks the 130 level, going down towards 120 or a little lower, it's not off the table. But I think that if you were to see some resolution between China and the U.S., this would be something that might benefit. Another stock is Baidu. And Baidu is trading down here at 197. The low for the year is 177. So monitor this stock as well, and see if it can hold this 177 level, 180 level, and see if in fact that it could possibly see a turnaround if there was a resolution there. One stock that is going up today, and I'll bring it to your attention because I think the story sounds awfully good, is Starbucks. And Starbucks revenue, I think, was a record. So obviously, that's a big company. And when you hear the word record, you got to recognize it. It's up 10% today. Can you see that? And if it can get above 65 here, well, it is above the 60 resistance there. So if it can hold water above 60, I think that'd be very impressive. Now, again, Baba over in China, where Starbucks is getting a very nice footprint over there, a lot of people in China don't want to wait in the store. So, what Baba is doing with Starbucks is they're running a delivery business where they deliver your coffee to your office or your home or wherever you want it delivered. And when you get there, you get a coupon to go into the store. So, they are very, very optimistic that relationship between Baba's delivery company and Starbucks could be a very big factor looking forward. The stock pays 2.25 here, and so basically, it pays you a dividend while you're waiting to see if this thing would materialize. But it looks like that move to 50 might be over, and then again, holding above 60 is going to be the key. And that'll only happen with time. So monitor it, but it's got an awfully good looking story. The oil companies came out. Oil slipping today. It's down towards 63. And But Exxon came out with good earnings, and their stock is just barely up now. It was up more. The better story out there is in Chevron, and in Chevron here, it had record profits, I understood, and that is up $4, up 4.5%. Now, again, there's still a lot of resistance on these stocks. Right around 110. That looks like a lot of resistance. So you got to be careful. A lot of people getting very excited about oil, but I'm seeing oil under a lot of defensive pressure. You've really got to get above 74 for it to get into a massive bull market. Otherwise, it's in a trading range between about 60 and 75, back and forth, back and forth. Yes, it's near the bottom of its trading range, but it's also showing an inability to rally. And again, the skirmish we're having with the Saudis may be a factor. Only time will tell. We're certainly having a skirmish with Iran, and that's something that's going to come into the picture pretty quickly here. One other thing about China is it did show that exports for soybeans dropped 29%. So if you want to look at another market that might benefit if we have a deal with China, it would be in the price of soybeans. And let's take a look at the price of soybeans right now. It's at 884. And the lowest it's been in the last 52 weeks is 826. So that might not be a bad line in the sand. I've been a believer if we can get above 9 and 950, that the thing could really get going a little bit. See, it had a big rally to 9, but it's having trouble at 9. So closes above 9 might be very, very interesting for the soybean market, which has, over time. Let's go back 10 years here and give you a perspective on what these prices have done in the last 10 years. I know many of you just do stocks, but in this particular market, it would be trading on the commodity exchange. And let's just take a look here, the last 10 years. Okay, this isn't giving me a 10-year graph, although I'm trying to get one. I guess this is only going back. It's only going back to 16. Well, you can see it almost hit 11 here, 1075. And so obviously if we can get above 9, there's some real estate all the way up to 10 that could be going on if we got a situation. And look at that volume right there. So I don't know. If they get a deal at the end of November with China, it could be quite a positive situation. All right. Let's see. We've covered the stock market and some of the key stocks out there. We've covered the interest rate situation. We've covered the dollar, and we've covered the gold and the soybean. So we've covered quite a bit today. And again, what I'd like to do here now is just take another quick look at the stock market and see if we have any more updates here on that. The S&P down 20. So it's starting to accelerate to the downside. Like I told you, we went up to that 200-day average area, 2756, and Apple is 11% of the Qs and 4% of the S&P. So if Apple's giving it up, it's very difficult for the indexes to hold these gains. And remember, it is a little bit of a down market bounce right now because we're not above the 200-day averages. In fact, we're not above the 50-day averages. So again, there is still vulnerability here. And let's see what that VIX is doing. Like I told you, it went down to that 17, 18 area, which last time it did that, it rallied strong out of as the market rolled over hard. So right now, your VIX, if it's above 20, again, yep, it's above 20. So again, if you're above 20, in my view, you're vulnerable to a spike up, which would mean again. Elections are Tuesday. You know it could get wild. Be careful out there. And again, learning how to use options as a hedge is a big thing. So try to contact me at my Gmail address, OptionProfessor@gmail.com. Discuss the possibility of how you can protect yourself. You can protect yourself on the up or the downside. If you feel like you're going to be panicking out of your stocks because you can't handle the amount of money at risk, you could replace those sometimes with call options. And those call options have limited risk and have a finite cost, but they put a hedge on just in case you're selling out at a terrible time. Those calls could bail you out. A good case in point is, if you got out of all your Amazon down at, 1450 or whatever, and you bought a call at 1500, and now you're back at 1650. That 1500 call that you put in there obviously hedged the fact that you might have sold at a very bad time when the markets were down. So again, hedging can be used to protect things from a drop, and it can protect you against having to chase a market back up because you got out or you failed to buy when prices were good. Again, lots to learn across the board. I invite you to contact me at OptionProfessor@gmail.com. Until next Friday, I wish all of you the best of luck and the best in all your trading. Have a great weekend, everybody, and we'll see you here next Friday.